Now we get back to what you call it as the cash flow statements. Now that we have finished the income statements out there and the balance sheet. Having finished the income statement and the balance sheet, the next obvious step is we move to what is called as the cash flow statements out there. We did a small example of cash flow statement. We worked on what is called as the Lone Pine Cafe. And we prepared a cash flow statement for that. Now, what did we do? We prepared a cash flow statement based on all the cash transactions. But in reality, imagine a business. Can you start tracking all the cash transactions, compile it at the end of every quarter or every year and prepare a cash flow statement? Is it humanly possible? Though yes, humanly possible, the number of transactions, the amount of time it will take, the amount of effort involved will be really huge, because you got to track transaction by transaction. What is the cash? Where is the cash gone? Where is the cash? You have to basically look at all the cash book and then start doing it. But is there any alternative for that? Yes, there is an alternative. What we do? The amount of the cash flow statement which we prepared for Lone Pine Cafe the other day is what we call it as the direct method of cash flow statement. Is there any other method? Yes, there is something called an indirect method. Now, what is this indirect method of cash flow statement? Simple. We have the profit and loss statement, and then the balance sheet. Can I derive the cash flow statement from this? Can I derive the cash flow statement from this? That is what we call it as indirect, and that also acts as what is called as your method to check the whole transaction. To method, basically what happens, it's a method that you adopt to check the accurateness of all your three financial statements. I should be able to interpret, I should be able to drop, I should be able to decipher the cash flows from the balance sheet and the P&L. When I say balance sheet, I mean the opening balance sheet and the closing balance sheet. That is one of the reasons, if you look at an annual report, you will have minimum 2 years financial statements given out. You will have a minimum of 2 years financial statements given there. I have 2 years financial statements given there. Ready? I have the opening balance, I have the closing balance, I know where is the cash gone and what is the cash gone on. That is what we call it as the indirect method. Of course, it has the same thing, what do you call it as, cash flow from operations, from investments, and then financing. It has all the same three basic classifications what we saw, but we derive it from an indirect method. Let me tell you how we derive it from an indirect method. Let me take a very small example. Let us take two situations. Let us take two situations out there. Let me say 1 second. Let me keep the keyboard inside so it's easier for me to write. Let us take case A, case B. Now, sales, there is cash sales, where there is cash sales 75,000. Cash sales for case B is about, let us say, 30,000. Credit sales for A is 0. For B is about 35,000. So, total sales 75,000 for this and 75,000 for this. Now, let me look at expenses. Let me use a different color for B for expenses. Oh, sorry, 65. Then I'm sorry, it is, I think there is a mirror out here. So sorry, let us make it 45,000 and that is 75,000. That's all. Why use a different color? Let me not even use a different color out here. Let me use the same red out here and then make it. Sorry, that's totally mistake from my side. Thank you, Sohail. Now let us look at the expenses. Supplies bought and used, bought for cash and used. Supplies bought for cash and used, in this case 35,000, in this case 20,000. Supplies bought on credit and used 0, 15,000. Wages paid in cash 10,000, in this case 5,000, sorry, in this case I will make it 7,000. Wages accrued not paid 0, 3,000. Now let us look at the profit. No tax, nothing, ignore it. 75 minus 35 minus 10. 75 minus basically 45,000, that will be equal to 30,000 is the profit out here. Case B, 75 minus 20, 55, 55 minus 15, 55 minus 15 is 40, 40 minus 10 is the same 30,000. Now, I look at the cash balance of both case A and case B. 75,000 cash, all these are cash expenditure. In case A, the cash balance is 30,000. In case B, what is the cash? Let me use a different color out there. I think I am going to use green out there. What is the cash? Only this is the cash. What is the cash paid? Only this is the cash paid. And then what is the cash paid? Only this is the cash paid. In reality, what is the cash balance they should have? 30 minus 20 minus 7. So, the cash balance they will have is 30,000, the cash received, 20,000 is the cash paid for supplies, 7,000 is the cash paid for wages. So, ideally the cash balance what he will have is only 10% of it, 3,000. With you on this? Now, can I derive it the other way around? Can I derive it from the profit? Yes, I can derive it from the profit. Now, let us look at the indirect method. For case B, case A there is no indirect method required, right? Everything we know very clearly. Case B, let us look at indirect method. What is the profit? Profit is 30,000. In the profit, that means profit is what? Your basically what do you call it as your total sales minus your total expenditure. In the sales of 75,000, 45,000 of credit sale is also included, which is not a cash receipt. That is, in the 75,000, this 45,000 of credit sale is also included. That is not a cash receipt out there. That is not a cash receipt out there. That is not a cash receipt out there. Because that 30,000 profit I have got after including this 45,000 as a credit sale. Am I with you or not? Yes. This 30,000 profit I have got in the case B after including the credit sale of 45,000. So what should I do to know what is the cash balance? I should exclude it. So I reduce non-cash revenue, that is what is called as 45,000. That is called as 45,000 out there, non-cash revenue. Now I go back. When I got this 30,000 profit, I have included this 15,000 of credit purchase that I made out there as an expenditure. But actually, has the cash gone out? The cash has not gone out. I have included that 15,000 as an expenditure, but has the cash gone out? No, cash has not gone out to that 15,000. So what do? I add back the non-cash expenditure. Add back non-cash expenditure. That is 15,000 out there. 15,000 if I am not wrong. Yeah, 15,000. Similarly, this 3,000 is again a non-cash expenditure. You have not paid, but you have reduced it and only got 30,000. So I will do add non-cash expenditure on supplies 15,000, add non-cash expenditure on wages. How much? 3,000. So what is that? What is the cash balance? What do you have? Plus 30, plus 15, 45, plus 3, 48, minus 45. So what happens? Your cash balance, what you will have? Cash balance. What you will have is the same 3,000 which we have arrived at out here. This is what we call it as the indirect method. So what am I doing? I am using the P&L and adding back all the non-cash expenditures and non-cash incomes and then finally arriving at it. So why is the balance sheet required? Yes, simple. Depreciation is a non-cash expenditure. You will know from the P&L, agreed. Now there is wages paid 50,000. Now what is due still? In this particular case, what did I do? I gave you in the form of two parts, paid in cash, paid in credit. Normally what I will say, wages 10,000. You go to the balance sheet, you will say, we will see wages is still due 3,000. That means what is the wages paid in cash? Only 7,000, 10 minus 3. In this case, I gave you separately, but normally all these things are not given separately. You have to interpret it from the balance sheet. If it is not paid, if it is credit, it will still be sitting tight in the balance sheet. So I need the balance sheet as well as the income statement to do what is called as an indirect method of cash flows. That is how basically it is done. Now let us, having said that, let's go back to Lone Pine Cafe. Let's go back to Lone Pine Cafe and prepare a cash flow statement under the indirect method out there. Under the indirect method out there. Now let me correct this cash flow statement of Lone Pine Cafe, but of whatever it is, on 30th. Under, in this is what we prepared that day, is what we call it as the direct method. Now let me prepare in the indirect method also. In the indirect method also, let me prepare a cash flow statement. I am just going to copy this. Just for the formatting, I am going to copy this. I will say indirect method out there. Now let me take out all these things out. I'm just going to get my balance sheet ready out here. Right? Let's do the indirect method out here in this case. Indirect method, when we do the indirect method, what is it we start with? We don't even start with this, we will say the profit or loss for the period. Profit or loss for the period out there. What is the profit or loss for the period out here? We will see this in the P&L statement that we prepared for what do you call it as a Lone Pine Cafe. The loss, profit or loss for the period, this is the profit or loss for the period out there. So, I will basically start with the profit or loss for the period out here. In this particular case, this is the profit or loss for the period out there. Now, what do I have to do? I have to add back all the non-cash expenditures that you see out here in this particular case, all the non-cash expenditures that you basically see in this particular case out there, all the non-cash expenditures. First thing we see depreciation on an asset. There is no cash outflow in that particular case. So, what do? I simply add back depreciation on the asset. I add back. What is the depreciation? What is the amount of depreciation on the asset? I am just going to pick it up only from here in this case. Now, what is the other expenditure you have added out here in this particular case? The operating license that you have utilized, $595. You have utilized operating license of $595, but is there a cash outflow? There is no cash outflow. Because you have deducted this as an expenditure, you have got this profit. Now, I need to know what is the cash. So, add back what is the operating license. Operating license, whatever it is, what is the money operating license out there, and that I just basically add back that. Now, further we go here. We're starting with the expenses. Let's go to the revenues part of it. There is something called rent, 7,500, miscellaneous, telephone, etc. All these three, if you look at the balance sheet out there, the opening or the closing balance sheet, there is nothing pending with regard to any of these. So, I don't worry about all that. What is it? Let us look at your F&B supplies. Your F&B supplies is 11,969. Now, please watch out here. I am just going to use this space for working out, for doing some kind of calculations out there. F&B supplies as per income statement. As per the income statement out there, F&B supplies as per the income statement is, let us go back and then let us get this amount out there, 11,969. That is being utilized out there. But what is the total stock that is available to you for the period between November 2nd and March 30th? What is the total amount of supplies that was available to you between November 2nd and March 31st? Now, opening stock of supplies. Opening stock of F&B, I go to the opening balance sheet. Opening stock of F&B, this is what is the opening stock of F&B out there. I had so much of stock of F&B in this particular case out there. That is, the opening stock of F&B in this particular case is so much. What is the closing stock of F&B? What is the closing stock of F&B out there? What is the closing stock of F&B? That means, what is the closing stock of F&B out there in this particular case out there? 2430 is the closing stock of F&B in this particular case. We have got all the three. Now I need to know how much I have purchased. How much I have purchased out there. This is the amount of supplies that is utilized. This is the amount of supplies that was there at the beginning. This is the amount of supplies that is there at the end of the month out. So we have the opening stock, we have the closing stock, we have this is all the supplies. Now let me get it. Out of these 11,969 supplies that is utilized, you already had a stock of about 2,800. So that means ideally, how much have you bought out of the amount of stock that you, this is the stock that you have utilized. Out of this, these are the opening stock. So how much you have bought, what you have utilized out there. This is the amount of stock that you have ideally purchased for what you have utilized. But for ideally, how much of stock, that is stock bought and used. I am sorry, let me rephrase it. That is F&B bought and used. 9169, same thing. Now F&B bought but not used. But not used. Not used means what? Not used means that is basically there in the closing stock for you. Not used, that is what is the closing stock for you, is not utilized. So what is the total F&B bought? Total F&B bought is 11,000. Total F&B bought. Bought is 11,599 is the total F&B bought. Beautiful. How much is the cash you have paid? I have bought something on credit, less credit purchases. Less credit purchases. What is the credit purchase? Go to the closing balance sheet. It says creditors for supplies 1583. It says creditors for supplies 1583. So what is the cash purchase? Cash purchase is 10016 out there. Cash purchase is 10016 out there. But what have you charged in the P&L to arrive at a profit or loss of, what do you call it as, arrive at a profit or loss of 10,854, you have charged 11,969. But what is the amount of cash paid? You basically saw what is the amount of cash paid. The amount of cash paid is only 1016. What is the excess charged? What is the excess charged in P&L as compared to cash flow statement, as compared to cash flow, as compared to cash flow statement out there? What is the excess charge as compared to cash flow? Nothing but this is the money this is the cash outflow. I am sorry, this is the cash outflow what you have. This is the cash outflow what you have. But you have charged this. That means 1,953 you have charged more. When you have charged more, what do I do in the cash flow statement there? In the cash flow statement out here, I am just going to add back that expenditure. That is, add back F&B expenses. F&B expenses for which overcharge, add back F&B expenses. How much is it? I have to say it's basically the same amount out here what I received, 1953 out there. So what have I done? I go back to my P&L. I said monthly payment to partners, nothing due, I have taken care of. Wages to part-time, I have taken care of. There is something called an interest. Interest is not an operating expenditure. Interest expenditure is not an operating expenditure for you. So what happens? It is a non-operating expenditure which you have deducted. So I add back interest expenses. That is about $540 out there. So what happened? Depreciation, asset, non-cash outflow. After deducting depreciation, I got this profit. After deducting operating expenditure, non-cash, I got this profit. I overcharged 11,000 and as a expenditure on F&B, whereas I paid cash only 10,016. We have arrived at. you have charged this. Then I added back interest expenditure. Yes. Let us look at the revenue. What is the revenue? Revenue was cash revenue. So much there is a credit revenue. After including the credit revenue, you got a loss. But have you received cash on it? You have not received cash on it. So what happens? What happens? Have you received cash on it? That is the revenue which is added. But have you received cash on it? No. What should your cash balance be? Cash balance be less by the so much. That is less credit revenue. How much is it? $870. How much is it? $870. Now what is your cash flow from operation? Cash flow from operation is profit plus this plus your so much plus your interest that you added back plus my credit revenue out there. That is cash flow from operations out there. You can see this cash flow from operations matches exactly with the same cash flow from operations here. This cash flow from operations matches exactly with the same thing out there. What did I do? I added back depreciation as an expenditure, which is deducted and you arrived at the profit. That is not a cash outflow. Operating oil license, you deducted and you arrived at the profit. I added back. F&B, you charged how much? You charged 11,969. Whereas what is your cash outflow? Cash outflow is 10,016. How did we arrive at it? We arrived at it in this way out here. F&B charged so much. What is the F&B used? Bought and used. Bought and used means this amount which is charged minus the opening stock is charged and used. What is charged, bought but not used? What is the closing stock? I have added this. So what is the total F&B bought? I have got minus what is due is the cash purchases that I have made, and that is what I have taken. So what is the difference I have taken here? Interest expenditure, it is not an operating expenditure. We will write it in the financing cost out there. So I have deducted out there. Then credit revenue, your revenue is higher, whereas your cash revenue is lower by 870. Lower by 870, so I have reduced it out there. Your cash flow from operations. Now we knew investing. Investing means we have to look at all the fixed assets out there. Equipment. Equipment was 523,200. Equipment has reduced to 50,000. The difference is purely because of depreciation. That is what if you take the difference, that is what it is. This minus the other equipment out there, it is exactly equal to depreciation. That is what we got, and so there is no investing activity. Now I go back here. Investing activity basically happens to be the same NIL out there. Now I go to financing. Financing is very simple. We deducted the interest expenditure out here. We added the interest expenditure out here. Now interest expenses. Cash outflow 540. Then I go back to my balance sheets. Bank borrowing was 21,000. Now look at the bank borrowing out here at the end of it, 18,900. What is the difference? That is, it was 21,000. The borrowing has reduced to 18,900 out there. The difference is 2,100. Why is the difference? Nobody has given you charity. The difference is because you would have repaid that loan. Repaid that loan means cash outflow. Repayment of loan. How much is it? 2,100 cash outflow. What is the cash flow from financing activity in this particular case? The cash flow from financing activity in this case, I am just knocking it off out here. Cash from financing activity out here is just the sum total of this. Now, in this particular case, what is the cash flow, total net cash flow from that cash flow for the period? Net cash flow for the period out there is this plus this out there. That is the net cash flow for the period out there. What are the cash at the beginning of the period? Cash at the beginning of the period. That is November 2nd out there. What are the cash at the beginning of the period out there? You can just go back up here and say what are the cash at the beginning of the period. Out here, there is the cash at the beginning of the period out there. So what should be the cash at the end of the period out there? The cash at the end of the period. So the cash at the end of the period. Will it be 1341, which basically is what we arrived at 1341. How is 1341? We got it, the same amount out here. This is what we call it as the indirect method of preparing a cash flow statement.